just about anybody who has a business plan and understands what the key drivers of their business and their industry are is ready for equipment financing. If you finance the equipment, you can get the equipment a lot sooner because you don't have to save up your hard-earned cash. And you can get that with either no money down or a minimal amount and have that equipment earn money for you or save money for you as you're paying for it.
Hi, everyone. I'm Chris Erholt, host of this interview with Danny Lebovics on behalf of Smarter Loan. He's with Armada Credit Group. So, Danny, about Armada, can you give me an overview of the company, sort of the products and services, and what your mission is, and what makes you guys different from the other competitors?
Hi, Chris. Thanks for having me on. Number one, our core competency is we provide equipment financing for commercial enterprises, whether it's a startup, small business, established medium-sized business, large corporates, government entities. We provide financing for anything that a customer would need or a business would need to run their business and to grow their business. And one of the things that we do differently is we look at sustainability of our product. So instead of trying to make the most amount of money on every deal, what we do is we treat all of the business partners in our ecosystem fairly, because we want to help them grow and we want to be around for the long run. We want to be their trusted advisor, so to speak.
What is your most popular financing product and who is it best suited for?
So most of the equipment that we finance is essential use equipment, meaning the business can't run without it, whether it's a manufacturing concern, we're financing a production line, or if it's a service-oriented business and we're financing, let's say, a medical device that they would need or computers for an office. You could get pretty fancy with the types of products that are available. But because of that, we typically find that our customers prefer a lease to own type of product, or what's otherwise known as a capital lease. They want to have certainty around what the monthly costs are going to be, what the overall costs are going to be, and they want to know that they own the equipment at the end of the term.
As a small business owner or someone in the fields you just described, what indicators would you cite as things that suggest you're ready for equipment financing?
We like to say that just about anybody who has a business plan and understands what the key drivers of their business and their industry are is ready for equipment financing. If you think about it from the perspective of a business owner or a decision maker in a business, you could either save up the money that you need to buy a piece of equipment, and it could take a long time to save up $100,000, $200,000, sometimes even more. And then you're looking at a payback period. So how much are you going to earn, or how much money is that piece of equipment going to save you? And the payback period, a really good payback period is, let's say, 18 months to 24 months, and sometimes it takes 5 or 6 years. Whereas if you finance the equipment, you can get the equipment a lot sooner because you don't have to save up your hard-earned cash, which probably is better served being put into working capital purposes. And you can get that piece of equipment with either no money down or a minimal amount of an upfront payment and have that equipment earn money for you or save money for you as you're paying for it. So the equipment typically pays for itself. What we're doing is, in our industry, we're changing the equation from what's my payback period to how much positive cash flow am I generating every single month. You're almost ROI positive from the get-go.
Okay, so for basic, how does one qualify?
If it's a small business and the business does not have a history of profitability, and the business, let's say you haven't accumulated any retained earnings in your business or equity in your business yet, then we're going to be looking at mostly the credit history of the owners of that business. So if you think about it this way, a lender doesn't want to have more risk in a company than the owners already have. And in terms of getting ready to borrow money, make sure that you're paying your bills on time, both in the company as well as personally, because a lot of lenders look at the personal credit of the owners, not just because they're taking a personal guarantee, but because how you run your personal finances is going to dictate or going to be a really good proxy for how you're going to run the finances of your business. So make sure you pay your bills on time. It's much more important to pay the minimum amount that's due instead of paying the entire amount off of one loan and then being late on others. Having available credit. If you're starting up a business, go out before you start up the business, take out your loans, take out the equity loan on your home for the additional capital you might need. Because before you start the business is your best time for the next couple of years until you achieve profitability to borrow money. If you're an established business, then you can expect to get a loan without having to take any kind of personal liability, without having to personally guarantee the transaction. And then obviously, if you're a very strong credit, then you can dictate terms to the lenders as opposed to vice versa.
So, I mean, you had some tips in there, but I'm going to segue from that. What are
Sure.
some things to avoid, the mistakes that folks make when they're in that initial period, like you described?
There are a few mistakes to make. A lot of companies, and especially if you're inexperienced with lending, you might think that your best option is the bank. And oftentimes the bank is the best option depending on what you want to finance. If you're looking to finance working capital, for instance, if you're carrying a lot of receivables, if you're manufacturing something, or if you're reselling something and you have to carry a lot of inventory, absolutely your bank line of credit is the best option because it revolves and it increases and decreases as you need it. If you're buying capital equipment, it might not be the best option for a number of reasons. Number one, because term debt is very capital intensive for banks, and meaning it's expensive for them. The way that most banks work on a risk adjusted return on capital model, they prefer to give you a revolving line of credit where they know it's going to be paid down quickly. And they also prefer to earn their money on fees. They don't necessarily want to have their money stuck for 5 or 6 years in an equipment loan. The second thing is that if it's available, the equipment financing provides an additional source of capital for a business, which is important. Whether you're a small business, medium, large business, managing your treasury is always very important. And you want to make sure that even if the cost of capital is incrementally higher, it might result in a couple of $100 incremental cost per month. It still gives you the availability of the cash that you needed, and then you could keep your bank line of credit open for when you need it for emergencies, or let's say one of your suppliers offers you a great deal on an inventory, but you have to act quickly and buy it in the next 2 weeks and pay for it immediately. So that's one of the things. The other thing is sometimes borrowers are seduced by a quoted low rate.
Right.
And a proposal or a quote is not necessarily a commitment. We see it much more often in the States than we do in Canada, but there are a lot of lenders out there, including banks and reputable companies, who quote one deal knowing that that's not a realistic quote. And then they come back, once you've invested a lot of time with them, they'll come back with, well, here are the terms of the committed offer that we're giving you. The other thing is some lenders are unscrupulous. I don't want to scare anybody, but they'll quote a certain rate that's not a true annual percentage rate. It's not an APR. And no matter how much you try and pin them down, if they know that somebody wants to hear that the rate is 5%, even though the rate might be 11 or 12, they'll tell them that. So the best way to avoid that, or to mitigate your risk of getting stuck in a situation like that, is either, there are a lot of calculators online. If you look up present value of money calculator, you can find something on any search engine.
Mm-hmm.
If you're a little proficient with spreadsheets, you can make your own, and you can calculate your own in Excel. You can go to your accountant who may or may not know how to calculate rates. Oddly enough, and I could say this because I'm a CPA, not all CPAs know how to calculate finance rates, but you might have a friend who's, at a car dealership, a mortgage agent, has the software. They could do it for you. The best way to do it is, if you're getting more than one quote, ask whoever is quoting you, say, I understand you're quoting me a certain rate. Please, this is the payment that I'm looking for, or give me what the payments are going to be with, let's say, a 10% first payment and the remaining payments over 59 months. And sometimes when you compare somebody's 5% rate to somebody else's 11% rate, you're going to find that 11% rate, if it's a true rate, is actually lower than what somebody is telling you is a 5% rate. The other, you asked me for three. The third one is that with startups, a lot of people make the mistake of not taking the money when it's available. And your best chance at getting the most amount of money is before you've started the business. You've invested a lot in terms of researching your market. You might have a great business plan. You've got really good experience in the industry or managing somebody else's company. You might have equity in your house, and that's the best time to go out and get an equipment finance loan or a lease, bank credit, because the next 2 or 3 years you're going to be building your business and your financials will not look quite as good as what the banks want to see or any kind of lender wants to see. So you're much better off taking what's available at the outset rather than waiting a year and a half or 2 years and then looking for money.
Right. When you're in that slugfest where you're not,
Yeah.
turning over. I see.
Yeah.
Okay. Another thing I found interesting about Armada and in this business specifically is what you guys can do regarding warranty coverage on a piece of equipment or recourse if for whatever reason one of your clients says this piece of equipment is not doing what we thought it would or what it said it would do. We need help. Please help us.
Sure. This happens quite often. What a lot of people don't know about equipment finance companies is before we do a deal, even if it's a one-off deal with a vendor of that equipment, we will do a background check on the vendor. So you're much better off as a customer buying tier one equipment and buying it either from its manufacturer, authorized distributor, authorized reseller, than you are buying either tier two equipment because you think you're going to save a little bit of money, or buying that tier one equipment, but from somebody who is not authorized to resell it. And there are a few reasons. Number one is because of the warranty coverage, which always passes through with the finance agreement. So any lender is going to give you the benefit of whatever warranty coverage and covenants the manufacturer, the seller has given you in their purchase agreement. That's number one. The other thing is you get the support. When you're buying from the manufacturer and authorized reseller, you get the support, the marketing support, the technical support that's supposed to come with that equipment, as opposed to just being left on your own to figure out what to do. You might say, hey, I'm manufacturing all of these widgets and I just don't know how to go out and sell them or get customers for them. I thought I would, but it's tougher than I thought. When you're dealing with somebody who's authorized by the manufacturer, they can give you that marketing support. They can help you get going. The other thing is when we're doing the background check as a lender on our vendor partners, we look at their history, we look at their credit worthiness, we look at whether they have a real establishment. Do they stock parts? Do they have technical support staff? Do they have marketing support staff? If it's somebody working out of their home, that's nice in terms of having them save money, but it doesn't help you as the purchaser or as one of their customers when you want to get support. It's not the same as, some of the vendors we deal with have a dozen just marketing support people in addition to their sales staff and their technical support and their parts and their warehouses across Canada. So that makes a very big difference.
Sure. I want to move now to current conditions. We spoke about it, but can you talk about the current economic conditions, interest rates, and inflation right now, and how it's impacting some of your customers?
Everybody in business, probably in the last 8 to 10 years, got spoiled by uncharacteristically low rates. Some businesses got used to that, and especially if they were capital intensive, they got used to the fact that their cost of borrowing would be 3 or 4%, which
Yeah.
is way out of line with traditionally where rates have been in the last 40 years. What we're seeing now is rates, even though they've gone up about 5% the last year and a half, they're still back. They're close to where normalized rates would have been and probably should be over the long term. I'm not a fan of it, but what we're seeing is a lot of our customers are reimagining or going back to the drawing board and tweaking their business model to make sure that they can still turn a profit with the 7 or 8% cost of capital. What it also means, though, is that in the next little while, it doesn't necessarily, well, for sure, it doesn't look like rates are going to come down for the next I would say 2 to 3 years, maybe even 4 or longer. But rates still might continue to go up. You keep hearing it's over, and then the Fed raises rates, and then all the regulators raise rates, which means that there's an urgency. If somebody is trying to make a decision to buy, it's a much better idea to buy now and lock the rates in now, because all of the financing we offer is fixed rate. We don't recommend revolving or floating rates to anybody at this point, and lock in the rates and at least have certainty around what it's going to cost to operate that piece of equipment.
So otherwise, so you're saying, get it now. Beyond that, is anyone opting to finance used instead of new, or financing fewer items than they otherwise would have because of the situation right now?
A lot of people are putting a lot more thought into whether they should make the commitment of buying something. So part of what we do is we take this huge expense or huge expenditure and turn it into a much more manageable operating expense over 48, 60, 72 months. But even with that, people are still considering, like they're thinking a lot more about whether they actually need that piece of equipment, or they want to make that commitment to pay $2,000 each month over the next 60 months.
Mm-hmm.
We are getting some people who, they're shopping. The look to book goes down a little bit because we're looking at more deals. And then when people realize the expense of it, then sometimes they say, now's not the right time. Maybe 6 months from now is going to be the right time, or 12 months is going to be the right time. And you have to respect that. You have to respect somebody who's a business decision maker and makes the decision that, they're just not comfortable taking on that additional responsibility for their business. We are seeing more people going to used equipment, and a lot of the construction equipment that we're financing and a lot of the trucks and trailers, the transportation equipment we're financing is used equipment. So long as it's low mileage or low hours, it still has a lot of economic useful life to it. And if somebody could get that equipment to do the same job at a lower cost, then that's going to be great for the business.
Right. So looking forward the next 6 months, what do you expect demand to be during this period?
We're seeing spottiness. Our industry, everybody's a competitor and everybody is also a friend. It's a very small industry, so we talk a lot amongst ourselves and try and find solutions for all of our customers and vendors. I would see, in the next 6 months, people are definitely going to be thinking about what they're going to do. In the US, it's a little bit more severe than it is in Canada in terms of what the portfolio performance has become. People are seeing serious softening in the quality of their portfolios. For the last 10 years, everybody in credit, made the right decision. Everybody was a genius in credit because delinquency rates and charge-off rates were at historical lows. Now they've been coming back again, normalizing back to where they traditionally have been. And a lot of the lenders are getting nervous about it. The banks typically are the first ones to decide to pull out of either an industry or an industry vertical. Decide, for instance, I don't like companies who do this, and then they call all their loans, and then they don't grant any more credit in that industry until somebody changes their mind. So in the next 6 months, as the doom and gloom becomes, hopefully it won't, but it could become a self-fulfilling prophecy,
Right.
then you're going to see tightening of credit, which makes companies who do what we do, which is, we deal with banks and pension funds, private equity money, life insurance companies to place really large deals for investment grade credits, but we also have alternative sources of funding, traditional equipment finance companies, private lenders. Companies who do what we do are going to become a lot busier as our customers and our vendor partners, on behalf of their customers, are looking for more fair terms for financing.
Right. Okay. Now, finally, I wanted to give you an opportunity to talk about anything new, or either product-wise or just strategy-wise at Armada that you want the folks to know about, the public to know about.
Sure. We're constantly looking for ways to improve our service. That's, bottom line is, so long as we're competitive on our rates and our terms, really the most important thing in our industry is speed.
Mhm.
And the quicker we can give an answer to a customer
Mhm.
with certainty, the better off that customer is going to be. They're going to be able to make a quick decision. Sometimes the vendor is willing to give them a certain deal, but they only have a limited number of units and they've got to commit quickly. Or sometimes, a customer could take advantage of the fact that it's the end of the month or the end of the fiscal quarter for a vendor and get a really good deal. And we have to be there to support them. So a lot of what we're doing is we're investing a lot of money in our ERP. It's pretty decent now, but we're constantly adding additional credit decisioning in it so that we can automate as much of what we do as possible. We're automating document generation. I would say probably 80% of all of our document packages are electronic signature right now. We've integrated a bunch of software into our system to allow us to generate electronic signatures. We're investing in APIs with our funding partners so that we can get funding packages in more quickly and get our vendor partners who refer the business to us funded sooner. We're looking at automating some of the insurance because that seems to be one of the key sticking points when you're doing a transaction is just getting the equipment insured and the delays in getting the equipment insured. So we're dealing with some insurance companies so that we can put our own insurance on for the first couple of months and give our customers the ability to sort out what's the best deal for them on insurance, but at least know that the equipment's going to be covered and that we can pay the vendor, keep the vendor happy and get that equipment into production.
Right.
We're making investments because right now we're a little company. We never set out to be a little company like everybody else. We've got big plans and we think that we do a very good job for who we consider our ecosystem, which is our customers, our funding partners, and our vendor/referral partners. And we want to continue to do a good job and stay ahead of the curve and bring innovation to them to help them grow their businesses.
I see. Danny Lebovics of Armada Credit Group, thank you so much for your time. For Smarter Loan, I'm Chris Herholt.
Thanks, Chris.